Good morning, everyone. Thank you for joining us. We're very glad you could all be here joining us on this webinar. My name is Abisola Agola. I am a senior manager in the transfer pricing unit at Andersen, and I will be moderating, or will I say, facilitating the webinar and the discussions today. Today, we'll be taking a look at a very interesting topic that I think is very topical and is something that taxpayers, consultants, everyone needs to understand and discuss. And that topic is the OECD's two-pillar solution. Well, what we're going to be doing is to analyze the two-pillar solution, right? And understand the impact with a focus on Africa and Middle East. So that's what the aim of this webinar session is today, just to look at the two-pillar solution. What does it entail? And what potential impacts can this two-pillar solution have for countries or companies in Africa and the Middle East? So we're hoping to have a very engaging and technically sound discussion on this very interesting topic today. The truth is that the two-pillar solution is coming off the heels of very extensive work that has been done by the OECD, trying to combat base erosion and profit shifting globally. So it's an extremely topical and timely topic for all of us to discuss. So we're very glad to have you here with us this morning. Now, I'd just like to mention that showing that this is a very much needed webinar, the webinar has attracted participants and registrations from over 200 registered participants from the Africa and the Middle Eastern region. So we're expecting a very full house and very good deliberations. Also, we have very seasoned panelists who will help us dissect this topic today and break it down so that our audience is able to understand the nitty-gritty of this topic. But before we go into the main discussions for today, I think it's very important we have a very short presentation. I think the panelists do not have to worry. I will not take your shine in quotes. This is just going to be a very simple presentation, just giving a brief background of the topic of the day, right? And then I would let the more experienced hands take up the details of this topic when we have the panel session. So without further ado, I will be sharing my screen, right? I do believe we can all see my screen, right? And I will just quickly take us through this simple presentation. So like I said, the topic of today is analyzing the impact of the OECD two-pillar solution on Africa and the Middle East. Now, the thing is, like I said in my introductory statements, that the two-pillar solution is coming off the heels of extensive work which has been done by the Organization of Economic Cooperation and Development, the OECD. And the work was done on the BEPS project. Now, BEPS means base erosion and profit shifting. Now, what it means is that the BEPS project preceded the two-pillar solution. So it might just be good for us to have basic understanding of what the BEPS project is and what it has done while we delve into the two-pillar solution specifically during the panel discussions. Now, we know that the world is getting increasingly more globalized, more interconnected, right? And what comes with such developments is things like digitalization. And it's important for countries, for the world as a whole, to look at the international tax laws and look at ways to address any specific issues or unique issues that may be coming up because of the changes in the international world, especially because of globalization. So what the OECD did was to look at the international tax space, look at certain activities by companies that they believe can lead into base erosion and profit shifting. So they came up with the BEPS project and they released a 15-point action plan to address base erosion and profit shifting. So this 15-point action plan was released years ago, I believe about 2015, 2016, and it was really hinged on three main pillars: coherence, substance, and transparency. Now, the focus of the OECD in releasing these action plans was to ensure that, first, we have coherence in the application and treatment of certain types of transactions. So of course, nobody wants a situation, and the OECD definitely did not want a situation where certain transactions will be treated differently in certain jurisdictions. So they came up and looked at certain specific transactions, certain things that are important to international businesses, and decided to give guidelines as to how these transactions should be tested. The idea of this is to ensure that there is a coherent treatment of these transactions, and it will avoid potential cases of double taxation. So that was the first pillar, coherence. In terms of substance, basically one of the focuses of the 15-point action plan was to ensure that transactions being conducted among companies in the international tax space actually have substance. There's an economic substance, there's a rationale behind you carrying out these transactions. So it was very important that substance be one of the pillars of the action plans. Now, the last pillar, and definitely not the least, is transparency. Now, the idea is, because the world is getting so globalized, we have multinationals, or we have companies in multiple countries across the world. You realize that sometimes it's difficult for you to get an insight into the operations of these companies, especially as the tax authority. So that is where transparency comes in. We want a more transparent, when I say we, I mean the OECD wants a more transparent international tax space where we are clear that companies are doing the right things and their information is available to the tax authorities to make the appropriate decision. So this was the basis of the 15-point action plan, of which the very first pillar, interestingly, was on the digital economy. So they released 15 action plans. Action 1 focused on the digital economy. But it wasn't up until 2021 that we had a landmark, landmark event, which was when the OECD introduced the two-pillar solution to address the comments in Action 1, which focused on the digital economy. The crux of the two-pillar solution, without going into too much details, is to seek to address the tax challenges arising from the digitalization of the economy. I'm sure we can all attest to the fact that the world is getting really interconnected much more than we ever had before. And digitalization is paving the way for this interconnection. So what this means is that traditional ways of taxing may not be able to achieve the aims of tax authorities, considering the new world that we are in. So that's why the Pillar 2 is extremely important for us the Pillar 2 solution, I think, is extremely important for us to analyze and understand the potential impacts. Now, the interesting thing is that with the introduction of the two-pillar solution, the OECD and the inclusive framework has actually had about we're close to 137 countries and jurisdictions joining in, signing up to the two-pillar solution, saying that they are interested in implementing this. Now, this is very significant because this is a large number of countries signing up to address a very important issue. And these countries are representing more than 90% of the global GDP of the world. So this is even further to showing us that this is a very important issue. If you had 137 countries signing up to the two-pillar solution. Now, the interesting thing is some countries haven't signed up to the two-pillar solution. My very own country, Nigeria, and Kenya are yet to sign up to the two-pillar solution. But the question is, why haven't they signed up to the two-pillar solution? Are there reasons for this? Are there issues or reservations for signing up to the two-pillar solution? These are part of the things that we will discuss during the panel session. Now, just to mention, for us to be aware that the target date for implementation of the two-pillar solution is in 2023. So it's extremely important because we're in 2022, the second half of 2022. It's extremely important that we understand what this two-pillar solution is about, considering the fact that potentially the year of implementation is next year. So this is just a very brief introduction, giving us a very general background as to the BEPS project, as to the two-pillar solution, and really what we would be trying to discuss today. So I have another slide here that just gives a very brief overview of the two-pillar solution. So we have pillar 1 and pillar 2. Just a very high level, the general idea of pillar 1 is that the OECD is trying to ensure a reallocation of taxing rights of large and profitable multinational enterprises. Now, the interesting thing that we need to understand here, we need to note here is that what Pillar 1 is trying to do is to shift focus from physical presence being the basis of taxing rights in a country to taxation on the basis of where you have business activities. Remember digitalization, globalization. So you may not be physically present in a particular country, but you're making money from that country. The question is, do we have the laws in place now to tax you? If the answer is no, Pillar 1 is here to solve that particular issue by giving us certain rules that will guide how to tax those kind of companies. Now, the second pillar in the summary basically just gives us, it establishes a global minimum tax rate of 15% for what I would call large multinational enterprises. Over 750 million euros. And the idea of this is that it's a way to curb incentives for MNEs to shift profits from high tax jurisdictions to tax friendlier jurisdictions. So this is specifically why we have on our panel, we have people from the UAE, we have people from Mauritius here to speak to this, to explain what the potential implication is. So the thing is, this is a very interesting technical topic that is very important for our taxpayers to understand. Hence the reason why Andersen came up with this webinar to educate the general public about the two-pillar solution. So I will try not to eat into the presentations or the comments that the panelists are going to make. I will stop my presentation here. I will stop the presentation here and just introduce our panelists, because we have, like I mentioned earlier, we have an extremely technical, seasoned array of people on this panel. So without further ado, let me just delve into the introduction of the panelists. So I am going to start with Gbemisola. We have on this panel, we have Gbemisola Adelowore. We have she is the Africa, permit me please. She is the Africa Local Finance Director at SAP Africa. Gbemisola, we are so glad to have you here with us. Good morning. Thank you for honoring our invitation.
Good morning, Bisola. Thank you. Thank you for the warm introduction. And good morning.
You're very welcome. Yes. So also on the panel, we have Titilayo Akinseye. Titilayo is the Group Tax Manager at Interswitch Limited. Good morning, Titi. Thank you for joining us.
Good morning, Bisola. Morning, everyone.
Good morning. Also, so I would like to mention that we have Titi and Gbemi are representing taxpayers, because we believe that this is a very important topic and we need to get the points of view of the taxpayers. So that is why we have Gbemi and Titi on this call. Now, we also have participants or panelists from other African countries. If you remember, the idea is to analyze this topic looking at the African and the Middle Eastern region. So we have our partner from Andersen in Mauritius. We have Fazil Soifu. Good morning, Fazil. How are you doing?
Good morning. Very well, thank you. Thanks for having me. It's a pleasure.
Yes, you're very welcome. Also, we have the managing partner, Andersen Tax Limited of the United Arab Emirates. We have Anurag Chaturvedi. Good morning, Anurag.
Good morning, and it's really such a great topic, which is like, is talk of the town at the moment in the UAE, and everybody want to understand a lot much about it. So I thank the team for organizing such a great webinar, and along with the industry experts, Ms. Gbemi and Ms. Titi all together. It really want to understand the perspective that industries are taking over. And I think it's a perfect place to come together to discuss this topic. Thank you so much.
Thank you so much for that, Anurag. You've taken the words or the thoughts out of my head. And last and definitely not the least, my partner, Joshua Banfo, PhD. He is the partner and global transfer pricing co-lead with responsibilities for Africa and the Middle East, a man that is wearing a lot of hats. So Josh, good morning.
Good morning, Bisola. Good morning, all participants, for having me.
Yes. So I would just like to say again, thank you very much for honoring our invitation and joining us at this session. And we look forward to very interesting and enlightening deliberations in the panel session. Now, before we go into the panel session, I'd just like to mention to the audience that there is a question and answer option. If you look at the webinar platform, you will see that there's a platform where you can send in your questions for us to answer, and we will try our best to answer the questions while the webinar is going on. So please feel free to take advantage of that opportunity. So we've had a very brief background of this topic, Josh, but as the expert that you are, I think it would be good if you can give us further details as to the importance, the meaning of the BEPS project, its importance, what it tends to achieve. I think it will go a long way to really enlightening our audience as to the importance of this topic. So Josh, over to you.
All right, thank you very much, Bisola. And I think you did a pretty good job of explaining what BEPS entails in your intro, but I'll just add a little bit to it. So first and foremost, to understand the project, you need to understand what the concept of BEPS is all about. Then you move on to what the project is about and what it's trying to achieve. So BEPS, as we all know, means base erosion profit shifting. And what that concept means is that there's this awareness that multinational enterprises usually use, tax planning strategies or tools to take advantage of gaps and misalignments in international tax rules in order to pay less taxes or avoid taxes. So that is what base erosion profit shifting is all about. Because when multinational enterprises take advantage of those gaps and misalignments to pay less taxes as they should, then they are actually eroding the tax bases of those countries, and typically the way they do this is through shifting of profits to other jurisdictions where they can pay less taxes. Hence the concept of base erosion profit shifting. Now, the concept then led to the project, right? So emanating from the financial crisis of 2008, 2009, clearly, jurisdictions, especially advanced economies, wanted to stimulate the economy. And to do that, you all need tax revenues. Hence, there was a tendency for each of those advanced economies to come up with unilateral measures in terms of tax legislation to actually protect their tax base. But they recognized that it could have adverse impact on multinational enterprises and global international trade. Hence, mandating OECD to relook the international tax rules and make sure that they try to mitigate or close those gaps and misalignments that was leading to BEPS. And that actually brought about the OECD/G20 BEPS project, which actually commenced in 2013. By 2015, through negotiations and reviews, they were able to come up with the 15 action points, which Bisola talked about. A number of those action points have been implemented, some legislated, locally and all that. But action point 1 actually focuses on the digital economy, which was a recognition by the OECD BEPS project that, look, the current international tax rules did not anticipate this type of economy and therefore focus on taxation based on fiscal presence. But in a digital economy, you're able to have economic activities generate income in a jurisdiction without being fiscally present. And such activities weren't being taxed in those jurisdictions. So action point 1 tries to address that. And we are still in the process of actually implementing the solution that is coming out of action point 1. What we need to bear in mind, and Bisola has talked about, is that the BEPS project itself was predicated on 3 key strategies, all right, or pillars. The first, as she said, was coherence, because there was the need for coherence in international tax rules. They didn't want a situation whereby each country goes rogue and come up with their unilateral tax rules. which could actually lead to misalignment. So coherence is very important. And when we talk about two-pillar solution and the challenges in its implementation, that objective is going to be critical. How do we have more and more countries sign up to that solution so that we achieve that objective of coherence? The second element has to do with substance. Usually when it comes to the tax planning strategies that multinational enterprises use, there was a recognition that sometimes they have these structures that do not have economic substance. So it was very important that they have measures to ensure that whatever structures you have in place as a multinational enterprise should have clear economic substance. So substance is very key in some of these BEPS solutions. And the last but not the least is transparency. You needed to look at it from the tax administrator's perspective. How can they have access to relevant information in order to effectively do their work? So there was a need for transparency. So you see that a number of BEPS action points have led to more transparency, such as the common reporting standards. We've seen country by country reporting. These are all new measures that has led to significant amount of transparency and information going to the tax administrators. So that basically is the background on BEPS. So today we're going to focus more on the action one, which is ensuring that we're able to tax the digital economy appropriately, and that led to the two-pillar solution. So Bisola, that is basically the background to understanding BEPS and how that led to a two-pillar solution. Thank you.
Thank you very much, Josh, for that. I believe it should be clearer to our audience, or rather the background to the BEPS project should be much clearer to our audience now. But I think it would be good for us to actually have an understanding of how the BEPS project itself has affected local laws in certain countries, which is why it's good that we have multiple countries represented here. So Fazil, if you can just tell us how the BEPS project has affected local laws in your country, we would appreciate that.
Sure. I think it's fair to say that from a Mauritian perspective, we've felt the full force of the BEPS rules, particularly in relation to actions 5 and 6. For those who are familiar with them, the OECD identified some harmful tax practices within the tax legislation in Mauritius. And over the last 3 to 4 years, we've had significant changes in the tax landscape in Mauritius, to the extent that if you compare the tax landscape today to what it used to be sort of pre-BEPS, it's almost, it's difficult to reconcile the two. Now, the whole point of those changes was to bring a harmonization, to get rid of what the OECD called harmful practices, and to bring the tax system in Mauritius in line with the international standards. To be able to do so, there were a number of changes that were required. There were a number of sacrifices that had to be made from a Mauritian perspective, because as many of you may be familiar with, Mauritius used to have a very simple, straightforward tax system, especially when we talk about the global business or the offshore sort of sector, where GBC companies, GBC1 companies, would be subject to a maximum tax rate of 3%. And it was as straightforward as that. And we used to have another type of vehicle called the GBC2, which would be completely tax exempt. So it was almost too good to be true. So then the OECD came in and they identified a plethora of issues that were not quite in line with international standards. So the government made a commitment here that we want to abide by the rules. We want to be on the white list, because at some point we were on the grey list and it didn't bode well for the reputation of the jurisdiction. And we want to be a jurisdiction of substance. So to be able to achieve those objectives and be on the white list, many changes had to be made. The GBC2 vehicle, which used to be a favorite tax exempt, is gone. It's been eliminated. The automatic 3% rate, whereby you can get a credit for foreign taxes without having suffered those foreign taxes in the first place, is gone. And likewise, there have been other changes that have brought in, so without going into sort of too much technicality. In its place today, we have a system that the government has tried to make as competitive and as attractive as possible, and I think they've done a really good job. But it's true that we've had to deal with some of the very strategic advantages that we used to have from a fiscal perspective.
Thank you very much. Thank you very much Brazil. I think Anurag, it would be good to get the perspective from the UAE.
If I talk about United Arab Emirates, always remained to be a country where exactly there was no taxes. So people know the UAE being a non-tax regime itself, and that is why the OECD and the global tax authorities, they start talking about being the grey list and blacklist and situation. So it was a time in 2017 when the UAE government has taken the action and in line with VAPS. So they have started with the very first thing about the value-added tax, which got introduced in 2018. The 1st Jan 2018, the VAT has came in, which started back in 2017. And then there was no looking back, the VAT of 5%, because UAE government, if you look into the UAE landscape, in UAE around 203 nationality lives in, and there are global businesses which are operating from UAE, considering its strategic presence, connecting the Asia to the Europe and to Africa, obviously. So there's a lot of trade that happens between other jurisdictions to Africa through UAE itself. And predominantly, it's all about trade. So the very first thing that came into picture was VAT, and then the government also introduced economic substance regulation, which is WEP Action 5, right? So that was the first time in 2019 when the economic substance regulation introduced, and it was required that all businesses operating in the mainland or the free zone required to demonstrate that they have substance, or do they undertake any of the relevant activity, which is like 9 of the relevant activities. So should you fall within any of the relevant activity, you have to demonstrate your physical substance out there. And that was the kind of initiative where you talk about coherence and transparency that started to get into the economy pretty smoothly. And that action also drove another point about introducing the BAP Action 13, which is the introduction of country by country reporting. So that also came into picture, having the global standard of Euro 750 million conglomerate that operate out of UAE. So initially there was a mandate that if any entity operate and it has a presence, the global M&E has a presence in UAE, then it can choose to have the reporting entity being UAE and submit the report to Ministry of Finance. And then later on during the 2020, we got it modified that if UAE headquarter businesses which has presence worldwide, only those are required to submit the CBCR within the UAE itself. Then obviously the multilateral instrument, and talking about multi-agreement procedures, which is already in pipeline. The government also decided to introduce the common reporting standard and the declaration of UBO. And that was like something which came in 2020, late 2020 and 2021, where all the existing businesses which operate within the United Arab Emirates have been required to submit the definition and details about ultimate beneficial ownership that they have within the organization, and it could be multi-layered. So there was a different procedure that they allow businesses to determine who could be the UBO and abide by the CRS standard. And last but not least, with respect to the OECD development, we are going to issue and launch the corporate tax effective from 1st June 2023 in the UAE, for which the public consultation document has already been issued. And businesses are within the UAE now started to prepare how they can address the ongoing, increasing and mandated requirement for strategic and business reporting, so that they abide by the laws. And UAE government is very focused and very much committed to address all the global challenges with respect to WAPs. And that's how even they've implemented AML and FATCA. To a greater extent here, AML is now getting very big thing and big issue out here in UAE, where people have used to do the trade before. Now they can't do that thing simply because there are a lot of reporting, there's a lot of procedure. And government, I remember the government, they have presented a data, nearly 500,000 businesses they have reviewed and given the report out there. So AML is also one of the big things. So that's what the development from WEP's perspective that is taking place in the UAE so far.
Thank you very much for that, Anurag. I think from everything you said and also what Fazil said, it is clear that the BEPS project has actually led to some significant changes, or will I say updates, developments in the tax space in your countries. So I would just like to give like a minute or two. So let's hear from a Nigerian perspective. Titi, I know you're a taxpayer, but you are aware of the BEPS project. If you can just give us in a minute or two, just talk about how you've seen the BEPS project affect local laws in Nigeria.
All right, thanks. So the BEPS project has seen to the Nigerian tax authorities, sometime in 2012, introducing the TP regulation, and then we saw a subsequent revision, which basically speaks to Nigeria also trying to align to global standards. And subsequent changes we've also seen is the introduction of the country-by-country regulation, which Dr. Josh mentioned, and also the reporting, the common reporting standards. And what we've seen generally is that it's actually then increased the level of compliance for taxpayers. You've seen enlightened and seasoned tax officers who are aware, and they are scrutinizing transactions just to be sure that there is no abusive transfer pricing transactions within entities. And then we've seen increased tax audits, scrutiny of transactions, focusing more on substance and evaluating the prices. So it's no longer business as usual for us. There's demand for information. So the FRS can't reach out and say, oh, I need this information, and I'm telling them, oh, I'll get back to you. There's now limited time to provide this information. So, and then, also recently we saw the introduction of the significant economic presence order. And, as we see, it's no longer the regular way that we see it and expect things to happen and say we have, tax laws that are moribund. Year on year, we've seen changes to tax laws, and in those changes, you would observe that the tax authorities are also trying to align the tax administration to global standards. So those are recent changes we've seen, and some others that we probably expect to see in a couple of years to come. Thank you.
Thank you very much, Titi. So Nigeria is not left out. There are changes also locally within the country from the BEPS project. But I think it will be good now to really talk about companies. We've talked about the various jurisdictions and how they've been affected by the BEPS project. Bemi, if you can just help us, share your experience, your understanding. How has the BEPS project impacted your organization as a taxpayer, as a company within Nigeria?
Yeah, thank you, Abisola. And we've been monitoring it very closely. Looking at the global profits, all the parameters that have to do with Pillar 1 and 2, SAP is definitely going to be impacted. So both at the global and local Nigeria level, we've been monitoring, the developments very closely and proactively. We don't have a choice to be but to be very proactive about it and not just monitoring it. Now, the kind of things that we've been, another thing here is the concerns that we have are mainly around things like, very high administrative need to report, when it comes to external reporting. The high administrative time, resources, everything that is required. And then also the fact that there's still some, if I can call them, gray areas. Now, part of the things in terms of, when I say gray areas, in terms of practicality, the visibility of it, and then also, how feasible it is to practicalize, especially in our industry. Now, in terms of the things that we've been doing, we've been having public OECD consultations. We've also been getting involved in working groups, engaging tax authorities, you know, it's very important for us as an organization, as a business, to provide feedback with regards to how this would impact us. And then also on the other way around, you know, also aside providing the feedback, also ensuring that we are also fully aware of the impact that this would have on our business, because, you know, as a business, we obviously need to survive, albeit the changes and developments that happen in tax regimes across the world. So it's what we've even had to do at a more global level, because it would impact not just Nigeria, but other countries, is because of the fact that it's very important. One of the things we're also doing is that we are literally beginning to work on implementation because of the tight timelines that we have, that you've also emphasized. I think several of us have emphasized in 2023. We've actually started putting structures in place in order to implement both Pillar 1 and 2. You know, one of the things we've done is to set up project teams, cross-functional project teams that involve our reporting teams, controlling, tax, IT, you know, in order to, what we have to do, even as an IT company, despite the fact that we, you know, run ERP, cloud, and put systems in place, for us, it's actually not the most straightforward of things. We also have actually put up a project team that would work on changing or adjusting the process and data modeling that is required to ensure that we are also able to implement. So from an IT industry, IT company perspective, we are proactively monitoring the developments, we are engaging the key stakeholders, getting involved in public consultations and working groups, and then also working on implementation, because we do not want to be caught unawares.
Thank you very much for that, Bemi. Titi, I don't know if you would like to share your own perspective from your company.
Yeah, so for us, you know, we've seen increased, you know, level of compliance, which sometimes could be a bit stretchy. So obviously to align and ensure that, you know, the tax and finance team is always compliant, we have the support of our consultants that help do that. But aside that, what we've also done internally is, you know, sometime in 2018, we actually had to, you know, reassess our structure and be sure that, you know, where the tax authorities come in, am I able to explain that, you know, certain businesses earning income from certain jurisdictions are actually paying the right amount of tax. And, you know, that assessment saw us, you know, having to restructure a business because, you know, solely the revenue was solely earned from Nigeria. So, and one can say, why restructure the business to then be a fully owned, you know, Nigerian business? Because I'm in a country with a low tax, you know, a low tax rate. Why not maintain? But then is, you know, InterSwitch is a company that owes nothing back with respect to compliance. And, you know, compliance, whether with, you know, tax authorities or other regulators, is really important to the management and even the board of the organization. So we saw that restructuring, which obviously skyrocketed, you know, our tax payment, but is also for us to align and be sure that, you know, when this implementation needs to happen, we are not just restructuring with limited time, but we've done things in place, and then we'll be able to transit to implementing the two-pillar solution. But another thing I should mention is that checking, you know, within the group, majority of our revenue is actually, you know, earned from Nigeria. So I don't see, you know, whether there will be any negative impacts with respect to the implementation. But obviously we are staying, you know, in touch and abreast with, you know, whatever changes that the tax authorities may bring to fall. All right, thank you.
Thank you, Titi. Thank you, Bemi. So I think what I heard us say is that companies, your companies are trying to be proactive. You're monitoring the tax space, right? You're trying to engage internally already to be certain that you're prepared for whenever there is, whenever the implementation actually comes in locally. So I think that's something that is very important for taxpayers to notice. A key takeaway, it's important for you to be proactive, important for you to start monitoring these developments so that when implementation comes in, it doesn't take us unawares. So thank you very much, Gbemi. Thank you very much, Titi, for that. But before going really now delving into pillar 1 and pillar 2, the details of both pillars, I think it would be good for us to maybe understand some of the issues or the problems that the 2-pillar solution is trying to address. Then we delve into the particulars and the details of it. So Fazil, if you can help us talk through this, what issues are the 2-pillar solution, or is the 2-pillar solution trying to address?
Thank you. You know, as Josh said at the start, the 2-pillar solution are a continuation of the different action points on the BEPS. And pillar 1 is actually what the initial action point to action point 1 could not actually, there was actually no consensus on the implementation of action point 1. Hence, it was back to the drawing board and trying to see whether we can come up with something with more consensus and with more sort of buy-in from the different members of the inclusive framework of BEPS. And then pillar 2 is focused, as we know, on the global minimum tax. And it's interesting to know that at the very start, the global minimum tax was not part of the original solution. The way that it's evolved over time now, of course, with the current rules that we have, there is a global minimum tax that's intended to address a number of issues. But in essence, and I'll go back to the 3 core pillars of BEPS, coherence, substance, and transparency effectively is what the 2 pillars are trying to address. And if I take pillar 2, for example, the concern clearly by the OECD was that as long as there is no harmony in the tax rates between different jurisdictions, as long as a jurisdiction could, in its entire rights, apply a 0% tax rate compared to someone else having a very high positive tax rate, there's always going to be an incentive for someone to shift some profits to that lower jurisdiction. Now, setting the tax rate is a sovereign right, many states will claim. So how do we reconcile that sovereign right with the intention to create a harmonized tax level playing field in order to deter things like tax avoidance and to address harmful competition? So with all of these in mind, the OECD came up with a 2-pillar solution. Of course, pillar 1 is more focused on the digitalization. And indeed, the way the world is moving, this is increasing focus on ensuring that the tax rules for such income and such activities are redrafted and aligned. And then, of course, the pillar 2 solution to address the problem that I've just explained.
Thank you very much, Fazil. So it's really clear that the 2-pillar solution is really just building upon the pillars upon which the original BEPS project was worked on. So it's important for us to note. So now I think it would be good for us to really get in and try to delve into the details of the pillar 1 and pillar 2. So Josh, I will give this work to you. If you can just explain to us or explain to the audience, how is pillar 1 supposed to work? What does it entail? Really, what is all of it? What is it all about?
Thank you, Bisola. So as we've said, pillar 1 actually is trying to address the biggest issue with the digital economy, in that, as we said, the current international tax laws focus on fiscal presence in a particular jurisdiction for you to be taxed. But in this digital world, we know that you can actually have economic activities in a jurisdiction without being fiscally present. So how do you then get taxed? Now, one way to do it would have been to say, hey, each jurisdiction, come up with your digital service tax. And in spite of the challenge of being able to determine the operating profit and therefore the taxable profit of that particular entity, when that entity doesn't have fiscal presence, so there'll be a need for you to either focus on some tax on sales or turnover, or more like a consumption tax or a sales tax. So there are these challenges. So to achieve the first pillar of coherence, what they've generally came together to agree on is to do a consolidated financial, result approach. So for any multinational enterprise group that is supposed to make such payments, they're going to look at the consolidated financial of that particular group and determine which portion of its operating profit that they need to allocate out to jurisdictions where they've had significant economic activities for that amount to be taxed in that particular jurisdiction. So that is the general idea. Now let me go into the
Hello, Josh. I believe there's a bit of disruption on Josh's end. So if while we wait for that to be sorted out, what we will just do is to just try to get more comments on Pillar 1 from our other panelists, right? So Anurag, if you can just explain, if you can just maybe follow up and explain to our audience what's for the specifics of Pillar 1, and also if you think the Pillar 1 will be beneficial to developing countries in Africa and the Middle East.
See, I mean, so we can discuss about that. So essentially, if I say that what Josh was talking about, the Pillar 1 and Pillar 2, when the OECD bring in the picture out there, the entire purpose and perspective about Pillar 1 and Pillar 2 was essentially to curtail the harmful practices of the profit shifting, right? So today we see, I mean, I'll put a nutshell word so that everybody can understand from a perspective that today we have various countries which is having various sort of regulations and rules depending on the country specific with respect to residencies, right? And today the businesses, what they're trying to see that they're using those residency rules, which is residency rules endpoint, right? The place of effective management, in order to find a way to shift the profit from a jurisdiction. So if we talk about number of jurisdictions, I'll not name the specific country, but then I can share that some of the countries have realized and changed the nature of their residency rules in the respective countries after the announcement of the Pillar 1 and Pillar 2. Effectiveness of those Pillar 1 and Pillar 2, we essentially we're going to see and discuss more. But they have changed the rules. So the global businesses, they are giants. The global businesses now they're trying to find out means and ways how they will park the income globally from all around the world to a particular jurisdiction, which has the rules saying that should you not have a place of effective management in the country where you are accumulating all the wealth, the tax will be levied where exactly this money is going back. So let's say I'm parking from all around the world, all the profits into a country which has effective rate of tax, let's say, 18%, 20%, or 12%. Now the country rule says that who is subject to tax? The person who is subject to tax who has a place of effective management here. But I have a company which has a substance, but no effective management undertaking at that particular jurisdiction. And then I shift my profit to another jurisdiction, which has a rate of tax maybe 4.5% or 5%. And that's how I pay that. So they said that, look, all these practices is under the scanner and under the limelight that the Pillar 1 will going to address, because they talk about the digital tax. So all these digital organizations which having the operations providing in different part of the world, but having not a significant substance, they will be under a scanner. And then the countries which is participating countries of OECD will going to implement the structure. And what is the OECD's view on that? They said that all countries are sovereign and can set the tax policy of their choice. But harmful tax competition and aggressive tax planning need to end. The tax haven that have thrived over years for offering the secrecy, which is like, you can say the transaction secrecy, and shell companies, right? And no or low tax profits booked there. So they need to go for a change. They need to really ensure that the transparency on such transactions are there. And when I met last time the policy administration team of OECD in Dubai during our seminar that we did, I learned that the G20 and OECD hosted global forums on transparency and exchange of information for tax purposes, and they put a stringent measures on the bank secrecy. Right. So this is where the initiative that is taken out of pillar 1 to ensure that the transparency is continue to be increased into the market, and such practices of curtailing and shifting the profit is being heavily penalized. And there's a heavy penalties out there. That's what he says. But in nutshell, if I can say that the OECD view is that with respect to pillar 1 and pillar 2, they leave the discussion and decision to respective countries to implement. And all around the world, businesses and tax authorities are thinking whether, and the measures around which is like less than 15%, they're thinking about to bring the top of tax. Essentially, if I talk about UAE perspective, in UAE, the corporate tax that is expected to come from 2023 is going to be 9%. However, in the UAE, there are 200 nationality lives, and then there's a number of businesses from all around the world that operate here, which has a subsidiary or a branch or a PE that they have here. And they fall within the bracket. And many of those businesses also operate within the free zone, which do only B2B transactions. So more likely they may not be covered under the UAE corporate tax. But that doesn't mean that they will not come under the scanner should we implement the pillar 2 within the UAE. And that time they'll be having the 15% exposure on the profits. Now, whether the 15% profit will be collected by the entity to which the UAE entity is consolidating or ultimate parent entity, or whether the UAE is going to retain the 15% tax, that need to be discussed between the country to country. OECD said that they don't impose the conditions on the countries. So the countries need to define their own structure and own mechanism by which they're going to be distributing or collecting the top-up tax from that particular perspective. Right. So that's how my view on the pillar 1 and pillar 2.
Thank you very much, Anurag. You've actually helped me to do something. I was going to ask you to help me to just explain from your point of view, pillar 2 and the global minimum tax. And I think you've already done that for us. So thank you very much. I believe Dr. Josh is back on. Josh, I know you really wanted to give your comments and explain the specifics of pillar 1. So we'll give you a couple of minutes to talk about, to just enlighten us about it. So Josh, over to you.
All right, thank you very much, Bisola. Thanks for the glitch. So clearly where I was going was the mechanics of pillar 1, because it has implications for why some of the, developing countries decided not to sign up, So as I said, the first step was to determine the in-scope multinational enterprises. That is the countries and the multinational enterprises that they will be actually looking at, analyzing the portion of their profits that they need to allocate out to marketing jurisdiction, to jurisdictions that need to have those profits tax. So that in scope was for the very large MNEs, so 20 billion consolidated revenue for the group, and that company should have a profit margin of above 10%. So you're looking at very large profitable MNEs. And some of the biggest arguments by some of the developing countries was that means that you're going to have a very small sample size of multinational enterprises to be taxed, in the early years. Another aspect is that after 7 years, they were going to revisit and review that threshold downwards. So at least the first 7 years, you're going to have very large multinational enterprises, that are highly profitable. Having determined those large multinational enterprises that are profitable, how do you then determine the portion of the profit that has to be distributed out? And that amount is called the amount A. So the way they determine is that if I take a large multinational enterprise that is in scope and I get their consolidated financial statement, I'll then determine the operating profit of that particular group. Based on that operating profit, there's going to be an assumption that 10% of that operating profit is going to be retained by that particular company for its what we call routine functions. So if that company is in some solution, what have you, 10% is going to be retained. Anything in excess of that is called the residual profit. All right. So if my consolidated operating margin is 20%, then 10% will be retained, and the residual profit will be the additional 10%. If it's 15, then 5% will be your residual profit margin. So based on that residual profit margin, a quarter is what will be allocated out for distribution to the markets where there's a significant economic activity. So that quarter is 25% of the residual profit. And that is what is called the amount A. So once you do that, you've then determined the total amount that has to be distributed out to jurisdictions that there's significant economic activities. So the next issue is what we call the nexus, or the taxing rights. So which countries or jurisdictions where there's economic activities will have the taxing rights and then have a portion of that amount A, which is 25% of the residual profit. So what they agreed was, if you have turnover of over 1 million euros over the course of that particular financial year, then there's significant economic activity, and therefore you are entitled to taxing rights of the portion that will be allocated to you. Remember, the allocation key is the revenue. So if the more revenue is generated from your jurisdiction, that means there's more activity. So revenue is some proxy, for economic activity. Now, based on negotiations, they also ETAF and developing countries argue that, look, a lot of countries are not developing countries are not large enough, so you wouldn't expect a lot of economic activities. So the what they agreed was that for smaller developing countries, which was measured as GDP of less than 40 billion euros, then that threshold will be lowered from 1 million euros to 250,000 euros. So if it's a small developing country and there's been some economic activity that is above 250,000 euros, then you get a portion of that amount A that will be distributed out. So clearly, this poses a challenge to a number of economies. If you take Nigeria, for example, our GDP is higher than 40 billion, so it's a large developing country. So they'll have to meet that threshold of 1 million euros as opposed to 250,000 euros for smaller developing countries. So that is basically how you determine the amount that is going to be distributed out, and then allocation key is going to be revenue. Remember that in addition to that is the fact that if you already had a data service tax, you have to repeal it in order to sign up. If you don't have a digital service tax, then once you sign up, you cannot introduce a digital service tax in addition to signing up to that solution. So that's basically the mechanics of determining the amount A, which is going to be distributed out. There's also an amount B in cases where, if you take, like, for example, an Amazon, and there's a warehouse in, let's say, Nigeria, and there's a baseline marketing and distribution activity, amount B will be determined, instead of using transfer pricing to determine what that distribution margin should be, they're going to determine a particular percentage that the amount B is going to be. I think most likely might end up around 3%, but we are yet to do that. And once they determine that, they will incorporate that in the TP regulations, so it becomes some form of a safe harbor on a going forward basis. But what is of interest is amount A, the portion that is going to be distributed out, and which countries will have the taxing rights, and how high that threshold is. Thank you very much, Bisola.
Thank you, Josh, for breaking down the mechanics as you have called it. I know this could be a little bit of a technical topic, but I believe, Josh, you've done justice to really break it down for us to understand the specifics of how it will work. Now, I think listening to everything everyone has said about the rationale for the BEPS project, the two-pillar solution, the mechanics of Pillar 1, specifically to Pillar 1, what comes to mind is this beneficial to Africa? Is it beneficial to the Middle East? Is it beneficial to developing countries? Because Josh, in his while he was speaking, did mention that some developing countries have reservations. So I think it would be good to hear from different people to understand their opinion on whether Pillar 1 in particular is going to be beneficial. So Anurag, if you can just give us a perspective from the UAE, we would appreciate that.
So UAE perspective, I said that essentially UAE was always a tax-free regime. So any sort of taxes that are coming out here, it may it may really be challenging for the businesses which came here and they built up the base just to ensure that they operate in a very low tax regime. So essentially there was no taxes. So when the taxes comes in picture, the businesses need to look into their, doing the business costs, right? They need to look into the structure that they have placed in the manner today. And they may need to reorganize their own strategies in order to address the other developing market from the UAE standpoint when the Pillar 1 introduced, because the global businesses are here, and the core purpose for them to shift here was essentially to have a benefit of lower tax regime out here. So as and when the Pillar 1 comes in, the businesses will definitely need to take a reshift about the CBA of the entire purpose and reorganize their strategies to implement that further along with the countering parties to which they do the business.
Thank you very much, Anurag. Fazil, from Mauritius, what do you think about the Pillar 1?
From a Mauritian perspective, honestly, Pillar 1 is not going to have significant sort of impacts because we're not expecting, first of all, as Josh said, the threshold for Pillar 1 is very high. And although there's very good intentions behind Pillar 1, and I was reading something the other day that the OECD predicts that taxing rights on more than $125 million of profits, something like that, are expected to be reallocated to market jurisdiction each year under Pillar 1. Now, to what extent this is reallocated to developing countries, to what extent it is to Africa and the Middle East, we don't know. The intention is there to ensure a fairer distribution of profits. We know where the large MNEs, the digital companies, are headquartered, not in the developing countries, not in the Middle East and Africa. That is clear. So in theory, yes, there will be a reallocation of those profits and the taxing rights from their home countries to the markets where the business activities are being undertaken and where the profits are being generated, regardless of physical presence there or not. So in theory, all is good, but in practice, because of the way that the rules are set out, because of the very high thresholds that have been identified, there are clearly reservations from the developing countries as to whether the objectives of Pillar 1 will be achieved. And hence, there's still sort of some question marks on that.
Okay, thank you. So obviously there's some question marks. So what I'm hearing you say is that in theory, it seems to make sense, but practically we're still not, or developing countries are still not sure about how positive the impact will be. Okay, that's good to know. I don't know if Beni, if you would have any comments that you want to add from a Nigerian perspective.
Okay. Now, whenever you have a change in tax regime, and thanks again, Bisola, whenever you have a change in tax regime, there would always be winners and losers. That's that's not rocket science. You would always have winners and losers. Now, in this situation, when you think about Pillar 1, the first assumption people will have is, a lot of countries in Europe, in the Americas would be affected because that's where a lot of the multinationals originate from. But have we also thought about the fact that we also have some thriving, multinational companies that originate from Africa and the Middle East? In instances where you have that, you then begin to have some conflicts with tax authorities because everybody wants the best for their country, Now, even though, I understand there was an update from the OECD stroke G20. They released something in July or so, very recently. Even though in all fairness to them, they did address some technical questions, it's still, like Fazil and Anurag just mentioned, it's still quite complicated, if I can put it that way. And the feasibility is not as clear, and when you have things like that, it does cause clashes between tax authorities. You can imagine a tax authority that is already used to benefiting so much from a particular or several multinational companies, you ask them to forfeit some, especially when it's not so clear. Of course, you get some some pushback. So, I mean, one of the things that we actually noticed from an SAP perspective with regards to this latest updates from the OECD/G20 is the profit reallocation. Yes, I know Josh did some justice in explaining, and I personally even understood it better when Josh explained it. However, it's still not completely clear how the countries, the companies in the countries that would be forfeiting profits, the whole parameter around the receiving and the giving, if I can put it that way, it's not it's not crystal clear. And that doesn't help in adoption. And that's why, you might not want to blame countries like Nigeria, Kenya. I understand Pakistan, Sri Lanka, some other countries are yet to adopt it. So there would always be winners and losers, and nobody wants to be on the losing side. That's just it. So I guess it's important for every country, every region in Africa, Middle East, anywhere really, to look, and I understand that is being done in Nigeria, and that's why they are yet to decide, to look at how it benefits each, it benefits their countries. It's easy to say, okay, the countries where you have the multinationals give some, and then a lot of the African and Middle Eastern countries would benefit. However, it also depends on the country's specific profitability. That's a very key factor. And then also the locally, the locally sourced revenues. So there's still a number of parameters, still a lot of clarity that is required. Again, there would always be winners and losers. So it's not a it's not an automatically aha moment for us in Africa. That's how I'll put it. I think it's important. The onus is on every country to look at it. Again, you may think probably later on there might be political, repercussions, if I can put it that way, for not implementing. So I guess for every jurisdiction, the government and the tax authorities need to strike that balance. Thank you.
Thank you very much. And I really like the last statement you made. It's up to each country, each jurisdiction to look at it and find a way to strike the balance, because there will be positives, there will be negatives. It's to determine what is best for each jurisdiction. So thank you very much for that, Wimi. Very insightful. I think now it's important for us to look, because we've really focused on Pillar 1. Is it important for us to look at Pillar 2 also, within the time we have left, to understand Pillar 2 and understand especially how beneficial we think Pillar 2 will be. I know Anurag did justice already to Pillar 2, explaining the minimal tax rates, right? But I just want to get his opinion, maybe in like a minute or two. Do you think, or how beneficial do you think Pillar 2 will be to developing countries?
I think Pillar 2 will definitely bring out the perspective. Number one, that if we see that the developing country which has essential higher rate of tax today, what the businesses are trying to do, that they are forcing, the other countries are forcing the country which has a little bit higher rate of tax regime out there to announce a tax holidays to flourish their economies, right? The number one is that there's a lot of tax burden, so people wanted to shift today as cost of doing business and economies of the scale are increasing day by day across the globe. So all businesses are trying to find out what is the best way to find a place which not only give them a competitive edge in terms of their production, their deliveries and things like that, but at the same time tax plays a critical role in terms of the profitability as well. So they always try to find out means and ways to reduce their ETR. And once the taxes are there, global minimum tax, so that gives a competition to a taxing economy. So if I take example of, let's say, Asia, most of the countries have very higher taxes. And if I come next closer to that is the Middle East, where the tax rates are either doesn't exist or very minimal. So the businesses and the tax authorities in Asia and Africa obviously have challenges from a Middle East perspective, that a lot of businesses shift out. The transactions have been done in a manner that give the flexibility to the business to not get a tax. So when the Pillar 2 get introduced, I believe the countries which are having a tax will have a level playing field. So they will be having a level playing field. At the same time, the non-tax regime or low tax regime will definitely need to find out the ways to carve out the additional amount of tax below the 15% threshold. So somebody has like 9%, somebody has at a 10% tax, the remaining 5% or 6% need to be gone somewhere else, right? So nobody wanted to let their revenue transit to other neighboring country because of the transactions. So I believe even within the Middle East as well, because Saudi is obviously 20% tax, whereas Oman is 10% and UAE is bringing the 9%. So they definitely will going to benefit because the tax regime is anyway there when the global minimum tax get implemented. They will be benefiting to tax companies which is operating out of free zone, which doesn't fit within the UAE corporate tax perspective. So it will be helpful, but its implementation yet to be seen. The region is businesses are at least vigilant in the UAE. So they are coming up a model whereby they wanted to study that how it is going to impact them. What all the countering and neighboring countries whom they have their specific transactions, what is their legal structure should ideally be in order to stay out of this ambit or to benefit out of that. So everybody is now today in UAE is very much open and evaluating their option, how they can really benefit out of pillar 2 and how they can curtail and practice out there. So I think in my opinion, in a nutshell, the countries will definitely benefit like UAE
Okay.
with the global minimum tax.
Okay, thank you very much, Anurag, for your comments. So basically, you're saying that there will be a benefit for you. You believe there will be a benefit to the UAE. Okay, thank you. Now, I would like to ask Fazil something. I noted something, Fazil, when you were talking earlier. You mentioned that there might be a bit of conflict or a need to reconcile the sovereign rights of a company to set their tax rates and the need to harmonize to have this uniform or minimum global tax rates. How do you think that will work, and how do you think, in light of this, how do you think it will impact Mauritius?
Thank you for that question. The way I see it, the dynamics with regard to Pillar 2 are quite different from Pillar 1, in that what Pillar 2 is trying to target quite clearly is low or no tax jurisdictions, or another way to put it is offshore financial centers. And Mauritius is often seen as one of such offshore financial centers. Although, as I said from the outset, we've had significant changes in our tax rates over the last 2-3 years, so that the headline rate of tax in Mauritius is now 15%, which is the global minimum tax rate. It is true that there are some tax incentives and some tax holidays that can reduce the effective tax rate to something lower than this. But gone are the days of the automatic 3% tax rate. So let me talk about the impact on Mauritius, and then to address your question a bit more broadly, what I think is the impact on sort of Africa and the developing world. From a Mauritian perspective, we need to also understand that there is a minimum threshold of 750 million euros, which is quite high. So assuming we're talking about those companies that are going to be in scope, and it's not the majority of companies who operate or have structures in Mauritius, yes, they will be affected to the extent that their effective tax rate is lower than the 15, which is why actually Mauritius have introduced or at least there is some wording that's been introduced in the law in the Finance Act, which just got passed last week, about a top-up tax with regard to those companies that are affected by Pillar 2. And this legislation is not enforced, not effective yet, but the provision is being made to accommodate future changes in legislation whenever we decide to fully go ahead and implement Pillar 2. So that's from a Mauritian perspective. Looking more broadly, however, the narrative here in terms of the impact on developing compared to developed economies is a bit similar with the narrative for Pillar 1, as I mentioned earlier, in that the essence of it is the same, preventing profit shifting and therefore trying to benefit those countries where there are more substance. Now, with regard to the minimum tax rate, and if we draw a parallel with regard to developing countries, typically developing countries have higher tax rates compared to offshore centers and international financial centers. So at face value, if you look at it, those developing countries with higher tax rates will be able to save from potentially the income or the investment that would otherwise be going to those lower tax jurisdictions. So one argument that has been bounced around quite a bit is that developing countries will be able to attract and retain more capital that currently is going to offshore centers. In practice, the jury's out as to how this will pan out, but in theory, at least, this is, for example, one metric being used to show that the growth rate from such changes in a post-BEPS world will be significant for developing countries. Likewise, the fact that the pressure on offshore centers and the pressure on low tax jurisdictions will discourage people generally from using them. So there'll be a change in in mindset. There'll be a change in appetite for using those centers. And again, in theory, the idea is that it will benefit countries with high tax rates, including developing countries. So, what I'm sharing with you is all theory at this stage. There's no evidence for this yet, but at least we can see how the narrative is evolving to try and show the benefit of Pillar 1 and Pillar 2 for the developing countries and for Africa and the Middle East.
Okay, so basically, in summary, we have perceived or we believe that there will be benefits, even though they are still theoretical, because we've not seen the actual implementation of Pillar 1 and Pillar 2. Thank you very much for your comments, Fazil. So I would like to bring it to a Nigerian perspective. I'd like to go to Josh. Josh, I know while you were talking, you did mention the digital service tax in Nigeria, and you did highlight the fact that Nigeria is yet to sign up to the OECD G20 inclusive framework on BEPS. Now, from a Nigerian perspective, what do you think, or what in your view is the reason for Nigeria's hesitancy in signing up? Basically, what do you think will be the pros and cons to Nigeria to sign up to the BEPS or to the two-pillar solution?
Thank you very much, Bisola. I think the way we need to look at it is this. When you look at the way OECD has analyzed the potential benefits of the two-pillar solution to developing countries, they've looked at it more from the perspective of what developing countries are going to get versus what they weren't getting prior to the BEPS project. And when you look at it from that perspective, you will argue that there's going to be some benefit to countries such as Kenya and Nigeria, because hitherto you didn't have a digital service tax, right? And so you weren't taxing any of these digital companies. So you had zero, and you're going to get something. So from that perspective, you can argue that there's going to be some benefit to such jurisdictions. However, when you make the comparison to countries, developing countries that either already have digital service tax or they intend to introduce digital service tax, then the comparative analysis is different. You're going to then compare what you're going to get out of the two-pillar solution versus what you're getting out of the digital service tax that you've either implemented or about to implement. And I think that is what Kenya and Nigeria did and came to the kind of conclusions they came to. All right. So let's look at Nigeria's case. You have to compare the digital service tax that is in place today and what they will get under the two-pillar solution. First, let's start with Pillar 1. If you start with Pillar 1, as I said, a number of companies have to be, fewer number of companies have to be in scope, right? Large multinational enterprise that's highly profitable if you are part of the two-pillar solution. And that limits the number of companies that are actually going to redistribute a portion of their profits. When you look at a digital service tax in Nigeria, there isn't such threshold. It's any multinational enterprise, that has significant economic presence in Nigeria. The only threshold they introduced was the definition of that significant economic presence. So almost every multinational enterprise is in a pool. So it's a population pool. Whereas if I'm part of the two-pillar solution, I'm just limited to large, highly profitable multinational enterprises. So that is a major concern for them. The second has to do with, the nexus, all right, the taxing rights. When you go to the Pillar 1 solution, that company, that large, profitable multinational enterprise should have had turnover of about $1 million euros or above. In the DST locally, you just should have made 25 million naira, which in today's dollars is somewhere around 60,000. So you're talking about 60,000 USD versus 1 million euros. Clearly, that's night and day. So if they look at it, all you need to do is have an economic activity to the tune of just 60,000 USD over the course of the financial year. And I get to tax 6% of that turnover. So the opportunity cost is huge for Nigeria, right? When you do that comparative analysis from Pillar 1 perspective. So when they look at what they potentially have to give up in terms of tax revenues that they could get from GST in order to sign up, then it becomes a very difficult, conversation. So that is one bit. I think clearly, if they didn't have to give it up, then maybe they would have considered. When you go to Pillar 2, which I think Fazil did a very good job of explaining some of the dynamics. Clearly, Nigeria being a high corporate tax rate regime with corporate tax rate of 30%, if you include the TET, that's the education tax, is around 32%. They are really happy with the concept of the global minimum tax. But as we've heard, ATAF was actually pushing for a minimum global tax of 20%, and it ended up with 15%. In fact, the high corporate tax rate regimes in developing countries, some were even arguing for 28% because they believe that that is the average corporate tax rate for most developing countries in Africa. All right. So if you're in Nigeria where your corporate tax rate is 30% and they put it at 15%, in their minds, it doesn't solve the incentive for multinational enterprises to shift profit from Nigeria to jurisdictions that are tax friendly. So that is a concern. You then throw in the threshold for the multinational enterprises that would actually be captured, which Fazil talked about, 750 million euros and above. Nigeria's biggest, competitors in terms of jurisdictions where such profits can be shifted would definitely be Mauritius and UAE, right, in terms of nearby countries and some of these other tax-friendly jurisdictions. If you look at it from that perspective, majority of those entities might not meet the 750 million euros. So really, there could still be incentive for profit shifting if the entity that is being set up in Mauritius is going to have, turnover less than that particular threshold. So when you look at it from Pillar 1 perspective, which clearly they are going to lose out compared to the DST, and the Pillar 2 perspective, which they like the idea, but practically might not be as beneficial as they thought, and they also talked about the TPD and the tax dispute resolution and where those disputes are to be held. Those are the three major concerns that the Nigerian tax authorities came up with for not signing up. Now, we also know from ATAF that, look, there are political, implications for not signing up. So ATAF has been mandated to actually hold conversations with each of these African countries in trying to convince them as to the potential benefits of joining, because there are some political implications, especially when you have your large trading partners signing up and you deciding not to sign up. So clearly, it's very clear why they didn't sign up. As to whether they continue not to sign up, it's another debate, but it all will be dependent on whether the very large, countries such as the US actually sign up. And we've heard already that US is reluctant to sign up to Pillar 2. And I don't think you can sign up to one and leave the other. So, maybe Nigeria would still stick to DST, or maybe they might join later on, but it will all be dependent on the successful implementation of the two-pillar solution.
Thank you very much for that analysis, looking at why, from a Nigerian perspective, the country might be hesitant to sign up to the two-pillar solution. It's a very interesting take. So I think, along with all taxpayers, we will just have to keep abreast of the developing space to figure out what exactly, or to find out what exactly Nigeria and other developing countries decide to do on this particular matter. Right. Now, I would really like to find out, we've spoken a lot about the two-pillar solution, and one thing that I think a recurring comment is about the uncertainties around the implementation of the two-pillar solution. So it seems we really need to look at this to understand if there might be any challenges in implementing the two-pillar solution. So I would like to ask Fazil, Can you just give us a highlight or explain what you think might be some practical challenges in implementing the two-pillar solution?
Yes, thank you. I think the two-pillar solution, as I've first of all set out, is whilst we haven't gone for the technical details of it, and it's quite complex, and this was going to be my first point, that there's lots of complexities in coming up with the effective tax rate and determining to what extent what is your rate and what is the top up that's required. It's easy conceptually, again, to think of you have a lower tax rate than 15%, and therefore you need to add back a top up to make it 15. But how you calculate that, a combination of different types of mechanisms and different types of rules, combined with some fancy accounting that you may have to do with your numbers to try and work out, the profits or the numbers on which you have to apply your tax rate, makes it a very complicated exercise. And it'd be interesting also to see how lawyers advise on this practically, because there's a lot of accounting that's involved to try and come up with the numbers on which you have to apply the rates to get the amounts of top-ups that are required. So that's one complexity. The other complexity is we've got to the different mechanisms that are in scope of Pillar 2. We haven't talked about it as part of the panel because it's very detailed and technical. But the payment of top-up taxes under different rules, for example, the income inclusion rule or the under tax payment rules can be different, and different countries may approach it differently. So whilst the OECD has given the framework for the implementation of Pillar 2, ultimately it's for every jurisdiction to implement it locally, and we're yet to see any legislation on Pillar 2. In fact, the UK was going to implement it from next year, but it's pushed it back to another year now. So we're yet to see whether there'll be sort of consensus or harmonization in the way that different countries introduce these rules. And the moment that you don't have it, even though the principles are the same, you start getting into more and more practical complexities. So that's, from the outset, that's why I envisage happening with Pillar 2, even though conceptually it may be easy to understand.
Thank you very much. Josh, do you want to add any comments, what you think might be the practical challenges in the implementation?
Yeah, thank you, Bisola. So I think Fazil has looked at, some of the practical challenges from, the practical analytical aspect of its implementation. But for the two-pillar solution to come into effect, there are a number of things that need to happen. So for Pillar 1, for example, there's a multilateral convention that needs to be signed by all the, inclusive framework members that signed up or approved this two-pillar solution. And already people are skeptical whether, all the 137, inclusive framework members that have signed up would actually sign the MLC, right? So that is itself a challenge. Now, if you look at developing countries, just about 50% of developing countries in Africa, to be specific, are actually part of the inclusive framework. Remember, 2 have abstained in, signing. The question is, what about the other 50% that are not part of the inclusive framework and therefore have not signed up to this? Are they going to follow through or not? So that in itself is another challenge. So we are all waiting and looking whether majority of the inclusive framework members that actually approve the two-pillar solution are going to go ahead to sign the multilateral convention, which would then bring the Pillar 1 into effect. On this other side, on Pillar 2, there are aspects that needs to be legislated locally. So each jurisdiction has to legislate, some aspect of Pillar 2. And we've recently heard that, in the US, which is a very major player in this whole process, the Senate actually couldn't have this bill passed. They voted clearly on party lines. All Republicans voted against it. Unfortunately, the senator from West Virginia, Manchin, chose not to vote in line with the Democrats, and that meant that this wasn't actually passed. And that's a huge problem, already Canada is looking at potentially doing the same and not passing it, because if their largest trading partner has not signed up to it, then why should they? Now, in Manchin's argument for not signing up, with this global economic challenge going on, it feels like this is not a time to actually hit large multinational enterprises, with this global minimum tax. So that is his argument, that this could actually hit these multinational enterprises that are typically American businesses. So if you have large players not signing up, then you most likely will have developing countries that are already, from the position that, look, they were shortchanged in these whole negotiations, giving them an incentive not to sign up. So I think OECD's work is cut out for them to be able to ensure that the large players do fall in line and sign up, so that it gives the smaller players who already feel that they've been shortchanged an incentive to sign up, because obviously there are political implications that can lead to the success of it. So there's going to be some practical challenges in terms of the actual implementation of the 2 pillars.
Thank you very much, Josh. I was just looking at my time and I realized we've been having such a good conversation, right? That our time seems to be really getting fast spent. So I think it'll be good for us to start beginning to round up. I know that they say time flies when you're having fun. I guess time also flies when you're talking about BEPS and the 2-pillar solution. So I think it would be good for us at this point, as we're rounding up, to look at what we think multinational businesses in Africa, in the Middle East, look at what they should do, how they should respond to the potential challenges that accompany the implementation of the 2-pillar solution. And I think this is such an important question that I believe every member of the panel should give us a comment. So I will start from the taxpayer's perspective. Bemi, what do you think, in like a minute or two, what do you think multinational businesses should do? Or what would be your advice?
Okay, yeah, thank you, Bisola. 2 simple things really, which I had mentioned before. First is to engage in public consultations. So it's important that as multinationals, we provide our feedback, and in the process of providing our feedback, you'll be clearer to the relevant authorities, how practical this is. And then secondly, preparing internally, preparing internally for the implementation of P1 and P2, especially with the tight timelines we are looking at. The fact that the multinational, for example, if you are based in a country where they are yet to adopt it, does not mean you will not be affected elsewhere. So implementation is key, putting all the right processes in place to ensure that, like I said earlier, even for an IT company, where we might have to do the same even for our customers at SAP, it's not the easiest of things. So I can imagine if the company is not fully automated and things like that, it's very important to proactively begin to prepare. Almost like when a new IFRS standard comes out, be prepared for this P1 and P2 pillar reporting. Thank you.
Thank you very much for your very concise comments. We really need to engage and prepare. Titi, I don't know if you have any comments.
Yeah, I think Bemi has rightly said what we as taxpayers need to do, right? So another thing, because I'm just thinking in my head, if the implementation is going to be effective 2023, and obviously it's a long and short time at the same time between when we're discussing this topical issue and end of December. What if Nigerian government decides to issue a legislation and say we hereby align by maybe we receive that regulation by January 2023? So I think it's really for us to internally assess what the implication would be based on the recent understanding that we are aware of, and obviously engaging with with our consultants like Andersen on how assessing our present business, what will be the implication, what are the things we need to put in place, in preparation. It's better to be prepared and Nigeria says I'm not signing in than not being prepared and Nigeria says I'm signing in. and we're all in a rush to actually, you know, comply with this solution. So I think it's is be prepared. Thanks.
Thank you. Thank you, Titi and Gbemi. Anurag, from a UAE perspective, what comments would you have?
I think it's very important question that, how shall we prepare? Considering the situation that, two options that today the taxpayers have and global M&E that they have questioned today is that shall we continue to wait for decision to happen or shall we act now? Because once a decision is made, let's say some of the contributors, as Josh was mentioning about US pass the bill or some of the largest economies that they pass the bill, then the choices will be very limited for them, the growing economies. So it's a choice exactly in front of the businesses today to first of all look into their structure to identify at what level they'll be falling within the pillar 1 and pillar 2, considering the global turnover. And then at the same stage, they need to understand what kind of transaction universe that they have, what kind of transaction within the group and outside the group that they have, where exactly the key supplier and customer relationship exists, what is and where exactly your value chain lies out there. You need to do functional analysis around those in order to determine. Now, these all things can't be done in a very small amount of time. You need to change your technology to access and allow the reportability of all these aspects to come at the right ETR when the global tax comes into picture. You need to flex your accounting systems. You need to flex the way you're operating in different jurisdiction, having a different sort of chart of accounts. So you need to look into holistically today, at least from a business perspective. The businesses need to look into their transactions around the world, look into the size of transactions, look into the value creation activities, look into their technology solutions, so they are in UAE. If I say predominantly, whenever we go and meet the global businesses out there, I can say that 3 out of 10 businesses are very concerned, and they are at least doing bit by bit planning in terms of global tax coming into picture, because they know if not today, 1 year later or 2 years later, it has to come and want to happen, right? And at that stage, they'll not have that much leverage and time to thoughtful analyze, plan it, and have the right ETR. So today they are doing their, the legal analysis, the economic analysis, and functional as well as technological analysis to harness the benefit of time that we have before the implementation begins. And I believe the critical challenges for businesses is these all.
Thank you very much, Anurag. I really like that you mentioned that companies will need to look into their accounting systems and also technologies to ensure that they are able to deal with the 2-pillar solution whenever it is implemented. So Fazil, I don't know if you have any comments on what you think companies should do.
No, I echo what Anurag and what everyone has said on this. Planning is required for sure. Systems need to be reviewed. One thing specifically that I wanted to mention is that given in certain areas, in certain businesses, whilst Pillar 1 and Pillar 2 have not been introduced yet, the impact may already be felt. For example, the other day I was looking at valuations and evaluate, in sort of valuing companies and businesses which may be in jurisdictions which could be subject to and impacted by Pillar 1 and Pillar 2. You have to try and factor in the impact of such, the introduction of such new measures, which becomes very, very difficult. So as well as try and plan from a systems, from a data perspective, you also need to see whether, there may be more required in terms of, potential impact on investment decisions, on valuations today, based on something that clearly there's still a lot of uncertainty on.
Thank you very much for that, Fazil. Thank you very much to all our panelists. I think I would like Josh, because our time really is fast spent. I'd like Josh to just give us some closing remarks and just to round up, just to kind of summarize the conversations and just give us some final remarks. And would I call it in charge to companies and taxpayers?
All right. Thank you very much, Bisola. First, let me thank all participants for actually joining in. I think the turnout was very impressive. Thanks to our panelists for taking time out of your very busy schedule to share your experience, your ideas, and knowledge about this topical issue. I think the message is very clear, and this goes to, all taxpayers that could potentially be impacted by the two-pillar solution. That the name of the game has to be proactivity. You need to be proactive. And being proactive means you can look at your status quo, what are the implications today, whether it's in Nigeria, digital service tax, and tomorrow, should there be a change, and should they decide to sign up, what will be the implications for our business? And should we start thinking about how we want to make changes so that we continue to be tax efficient and tax compliant? So I think these conversations with taxpayers should be ongoing. Hopefully, we've all learned something new, something beneficial. Even as a panelist, I've learned a lot, so let's be proactive and let's keep this conversation going, and let's keep our attention in this particular space, because, any significant changes can have very impactful, implications for businesses. And so we really need to pay attention to what is going on in the international tax space, especially when it comes to two-pillar solution. Thank you.
Thank you very much, Josh. I really like you referenced one of my favorite ABBA songs, The Name of the Game. I like the way you said the name of the game has to be proactivity. So I think if there's any key takeaway that we all need to take from this meeting is that proactivity is very important in addressing the two-pillar solution. So I think at this point, we'll come to the end of the webinar. I would really like to say a very big thank you first to all our panelists. I know that you've had to take time off work, or we have time off work to prepare for this session, and also to join us live here. So we're very grateful to you for honoring our invitation. Also, I'd like to thank the audience. Thank you very much for joining us, and we hope you found it very engaging. I know that I found the session very engaging, and we hope that when next we have another session, you will heed our call. This also goes out to our panelists also. So at this point, I will say a very big thank you again, and I hope we all have a great day. Bye, everyone.
Bye.
Bye.